Okay, so today what we're going to do is we're going to talk about how you can use Worth Unlimited to explode your core business. Worth Unlimited is the perfect value-added service for many types of businesses. For instance, financial planning and insurance agents, especially those that do the financial planning side of insurance, are some of our best referral sources. This program actually solves one of the biggest problems that they have in their industry, which is client attrition. This is also the perfect value-added service for anybody that deals in real estate or finance. So that would be realtors, mortgage brokers, bankers, accountants and CPAs, people that work in the credit restoration industry, people that work in credit in any way whatsoever. It also can be a great value-added service for people that sell big ticket items, but we're going to focus on those first industries here today a little bit. Now, let's talk about business in general. Is it possible that you could just do a few little things different in your regular business, doing what you already do? Things that can get people to sit up and take notice of you. Things that will grow your existing business in ways that you haven't tried before. That'll get you new clients and help you make more money. Well, the answer is yes, and you can do all that while you're doing what you already do. Now, let's talk about how business works. I always like to use the analogy that business is like a three-legged stool. The first leg is your product or service, and obviously that has to be great. Second is marketing and sales, because without clients, it doesn't matter how good your widget is. And third is management, because if you don't manage the whole thing properly, then you don't have a strong, viable business. And over half of all business failures, according to the gentleman I talked to at SCORE, are due to bad financial management. Even if you look at a lot of studies, that'll range from anywhere from 45% to up to 60% of small businesses failing due to financial management issues. So all of these three legs of your stool have to be strong. Let's talk about the marketing leg. What would happen with your business if you could expand your network of referral sources and warm leads? What would happen with your business if you had a unique way to differentiate yourself from competitors in your industry? And how about something that acts as a Trojan horse? Have you ever tried to get your foot in the door in certain ways for your core business and found that it was really difficult? What if there was a way that you could easily get your foot in the door with certain clients or certain opportunities, and then that relationship then ended up translating into your core business later? And then how about just getting yourself some new skills and surrounding yourself with people that can become a source of those new skills and your strategic marketing partners? Now let's talk about management. There's a lot of different aspects to management in a business. One of those is time management. Now, in most businesses, we're always trading time for dollars. But how about leveraging our time? Wouldn't it be great to establish an area of our business that brings us in a passive income stream or a residual income stream all the time, whether we're working or not? I love the fact that the last time I took a vacation, I was gone for 2 weeks and I made $6 grand during the 2 weeks that I was on vacation. Now, it took me over 9 months, almost a year, to build my business up to the point where that was happening. But I tell you, it really makes you sleep good at night knowing that you're going to have income coming in even if you're down with the flu, even if you're off on a cruise, even if you're spending some time developing a new business. Now, financial management, again, is part of managing a strong business. If you don't have good financial tools in place for your business, you could easily not manage your money properly, which means that the very first time a slow season comes along or a downturn in the market, your business is dead in the water. You always need to be managing your money effectively so that you've got money to carry yourself through any of those little bumps in the road. And then, of course, tax management is part of that. Before I joined Worth Unlimited, I was teaching tax strategies. would go in and do a half hour to 2 hours on tax law and or marketing for realtors, financial planners, mortgage brokers, insurance people. And one of the things I learned in my 8 years of working in the tax side of business is that the average business overpays their taxes. Now, the GAO does a study of this every year, the General Accountability Office, part of the federal government, and they've determined that the average small business person overpays their taxes from somewhere between $8,000 and $12,000 a year. It goes up and down every year. $8,000 or $12,000 a year, and a lot of that is simply due to people not properly tracking the tax deductions that they have available to them. Part of it isn't that they don't know about all the tax deductions too, but about 50% could be attributed to just poor record keeping. So if you had a better method of record keeping, a system that actually motivated you to be a better record keeper, wouldn't that save you a lot of money right there as well and help you make your business more financially viable? Now, when it comes to leveraging your time, what would you rather have? Provided that all the incomes are equal incomes, would you rather have 100% of your own income, or would you rather have 10% of 30 people's income? Well, obviously we know the right mathematical answer to that question, okay? And that's something that you can build up with Worth Unlimited. You can build a team of people that you're making overrides off their income. And when that team grows large enough, that's when you work yourself into a position where you're having money coming in every week, whether you're working or not. And again, 45% of all small businesses fail due to financial management issues, and according to some experts I've talked to, it's over 50%. And again, the average small business person overpays their taxes. Well, what if there was a solution to all the issues that I just actually brought up there? What if there was something that could help you in all of these issues, and it was something that you could just handle with one product or service? Well, that would be Worth Unlimited. Okay, Worth Unlimited is the perfect value-added service for many of you to add to what you're already doing in your core business. Partnering with Worth Unlimited as a referral agent means that you're going to have strategic marketing partners. Okay, Worth sort of becomes that for you anyway. The contacts that you make through Worth often are contacts that you can translate into customers in your core business. Worth becomes a Trojan horse to get new clients. Your fellow Worth referral partners become new referral sources for your core business as well. And when you're out there doing recruiting, and there's a great video on our YouTube channel called, I call it the cold market approach, and I teach how to recruit to sell. And when you're out there recruiting, you'll end up with two benefits from that. You'll end up with people buying the Worth account, and you'll end up with people that can become good referral sources for your core business, especially when you recruit in strategic industries. Those industries that are traditionally good referral sources for you, but that don't compete with what your core business is. And then, again, people that you work with, that you meet through Worth, can help you by bringing new skill sets to your team and providing you support. And then, of course, Worth provides you with another income stream in your business, doing what you already do. Without really spending a lot more time working, you can build up this second income stream. And then what if you were appropriate for using the Worth account yourself? Do you have debt? Do you have a mortgage? Do you have credit cards? Do you have car loans? If you have any kind of debt whatsoever, you should take the time immediately to get your own savings analysis run to see if the Worth account could help you. Because the Worth account is perfect for a small business owner to manage their cash flow more effectively. It has reporting features that separate out your personal income from your business income, your personal expenses from your tax-deductible business expenses. It allows you to create unlimited tags for expenses and produce reports to make tax tracking and tax time easier. It makes you a better money manager. It improves your credit score, meaning that you'll be able to get cheaper credit forever. It helps you build cash reserves, build investment accounts. It'll save you tens of thousands of dollars in interest. And again, it tracks your income and deductions for tax purposes, helping make your taxes bulletproof. Now, what if you could just refer and earn? What if this was a product that almost everyone actually needed? Did you know that about 85% of people out there have debt? And then what if this product saved people on average over $120,000 in interest as they're getting debt free? And it allowed them to set themselves up for the future, that it forever changed their financial life and that of their kids. Because you know what? Debt is one of the biggest threats to families. It can be the difference of whether your children get a good start in life. Because if you can't help your children go to college, then you're not actually helping them to get that start that I know you really wanted to help them get. And then what if you could help people by simply telling them about this program and offering them a free savings analysis? What if you could earn up to $1,000 every time one of those referrals got the program? And the referral fees for this program that you get on average are between $300 and $900, but when you start hitting those volume levels, they can be up over $1,000. Now, what if this was an award-winning program that guaranteed results? Well, it is. As a professional in your core business, what kind of clients do you want? Doesn't it benefit your business when you develop clients that are able to stick to their financial goals, have better credit scores, have more discretionary income, and clients that appreciate you so much they're referring more business to you? Okay? And also clients that are referring more business to you because they're actually earning referral fees themselves for doing so. The beautiful thing about Worth is that when you're in certain industries like financial planning or real estate, you legally can't give referral fees to certain people because they're not licensed. However, there's no license required for Worth. Anybody can earn a referral fee, which means that you can turn your clients into referral sources for Worth, and those referrals are going to benefit your core business as well. And then, of course, how about more residual income from financial products you've already sold if you're a financial planner? Do you know that industry studies show that the average client will only stick to a financial plan without changing it for about 1 year, and that's only 14% of those clients. Over 80% of clients in the first year of a financial plan have either lowered their monthly contribution or canceled the plan. Okay? Worth has the ability to get clients to stick to their financial goals. In the first 4 years of selling this product to our clients, we found that 95% of our clients were still using the program 4 years later. Still to this day, we find that our average client's getting 20% better results. So what if you could get more of your clients to stick to their financial goals? And then how about a prospecting tool, again, and a Trojan Horse that really makes you stand out from the crowd and helps you get your foot in the door with client sources or referral sources that were a challenge in the past. Now, the landscape of America has changed. There's a lot of things going on in our economy that are not necessarily positive things. I'm sure you've noticed. In a way, it kind of benefits us in the Worth account because the economy crash was a big wake-up call to a lot of people. Did you know in 2005, before the economy crashed, Americans had the lowest rate of personal savings since 1933, which was the worst year of the Great Depression. So when the economy crashed, nobody had anything in their pocket. They were living paycheck to paycheck. It was a big wake-up call. You see people, even people making good money, having good cash flow, who are starting to put more money away and taking steps to reduce their debt. Okay? Unfortunately, some of the statistics here are pretty scary. They're still pretty depressing. The average debt is now almost $44,000 for every man, woman, and child in this country. The average credit card debt is almost $16,000. The average interest rate, 17%. The average mortgage is $240,000, and the average new car loan is $28,000. Did you know that almost half of Americans say that they can't afford to retire ever? And a study backs this up, showing that the average American is not going to be able to afford to retire until age 84. Now, what does that mean? It means that for a lot of Americans, their retirement plan is really going to be death. And then later retirement age means fewer jobs for the next generation, for your kids, for your grandkids. Okay? So, unfortunately, the landscape of America has changed, but the needs and desires of our people haven't. People still want to get ahead. They want to own their homes. And what does the future look like for us? What does it look like for our kids and their kids? Shouldn't we be focusing on the quality of life, not the quantity in life? Because what do we want the future to look like for the next generation and the next? Well, there's some other ways that the economy crash has affected us. One, it's affected our business economy. Did you know that HR executives name employee financial illiteracy and stress the #1 most critical unaddressed workplace issue? Okay? Your personal finances interfere with your company's ability to be productive and provide you with a job. Okay? Now, here's some statistics. 61% of employees report that they are financially stressed. 29% report that their financial situation is negatively impacting their job performance. Another study showed that companies are losing 12 to 20 productive hours per month per stressed employee. Now think about that. If you're doing payroll, take 29% of your employees, take your average hourly wage, multiply that times just 12 hours per month, the lower end of that, and you can see that this is impacting companies in the millions, if not billions of dollars. And employee financial stress hurts companies in other ways other than just lost productivity. It increases their healthcare costs because stress is a leading contributor to health issues. If people drink too much, they're drinking more. If they're smokers, they're smoking more. It all has an impact on their health. It has an impact on the cost of health insurance. Other ways it can impact companies is in their safety. Companies that have safety as a concern, distracted workers are more likely to injure themselves or their coworkers. Financial stress is a leading cause of divorce. How disruptive is it in a company when employees are going through a divorce? Often it means a company could lose a good employee because of the upheaval in their personal life may cause them to have to relocate. Okay? So this is costing companies in a lot of hidden ways that they're starting to recognize. There's a lot of problems with debt. It costs companies billions of dollars. It costs you your retirement. It robs your kids of a better future. It is a leading cause of divorce, and it makes everything we do cost more. Well, here's a problem with that. How about this discretionary purchase? Now, this is just a little green egg barbecue grill. I put it in here because I've been wanting one of these barbecue grills for a while. They're really cool looking. Okay? Now, that green egg barbecue grill I think really costs somewhere upwards in about $500. But let's just say it was on sale for $200. Okay? And I had $200 in my pocket and I did not have any debt. I'm debt free. Well, that's great. I can take that $200 and go buy that barbecue grill that I really don't need because I have a barbecue grill. And that barbecue grill is only going to cost me $200. But what if I just took out a brand new 4% mortgage? Well, now I have a choice, don't I? Because I could have taken that $200 and I could have sent it to my mortgage as an extra principal payment to pay down my debt faster. If I did that, that $200 toward my mortgage would save me $460 in mortgage interest over the life of the mortgage. So that means that if I choose not to do that, if I choose to get the barbecue grill instead, did that barbecue grill really cost me $200? No, that barbecue grill cost me $660. The $200 I spent for the barbecue grill that did not go into the equity of my house, and the extra interest that I'm paying because I did not use it to accelerate that debt. Okay? Now, of course, it actually really cost me a little bit more because if you think about it, if I'd have put the $200 in the equity of my house and my house is appreciating, I'm putting toward $200 towards something that is appreciating in value, so I'm getting a return there. But that's a return that we can't really measure in hard dollars right now, so I didn't include that. But let's say I have just credit card debt. Let's say I don't have a mortgage. Well, based on, and I didn't use 2012 or 2013's credit card numbers on this, I used the current average interest rate, but I used the average amount of credit card debt from back in 2010 for this calculation. Well, this barbecue grill could easily cost me as much as $1,200 if I had spent that $200 toward the barbecue grill instead of accelerating the credit card debt. And then if I had credit card debt and a mortgage, this barbecue grill could cost me as much as $1,600. Okay? Debt makes everything we do cost more. So doesn't it make sense not to have any debt? Well, as I mentioned, the good news is people are starting to wake up to the fact that debt is not good. Okay? We've been brainwashed in this country way too long. People are starting to pull their heads out of the sand and look around and realizing that they're about to get run down by their train wreck of debt. So I want to introduce to you the Worth account. And I'm going to show you a little bit about how the Worth account works and why it's a great value-added service for your business, especially if you're in any business where you're talking to people about money or real estate. Now, just a little quick heads up on who the leaders of our Worth team are. I'm Sue. I'm an executive director with Worth Unlimited. I was a branch manager with our parent company, United First Financial. I was a speaker with Bradford & Company, teaching tax strategies for 8 years, and I've been a business owner myself for probably 15 years, 20 years. I am a leader in Worth. I was a leader in You First as well. I know the company inside and out, so I'm a great resource to come to. I'm available to talk to your clients. I'm available to talk to your potential agents. Just tap me. Put my cell phone number in your phone. Call me anytime. My cell phone number, by the way, is 407-443-0348. That's 407-443-0348. You'll also find it on my websites. Our other team leader is Jody Humphrey. Now, you may recognize his name. His father, Hubert Humphrey, was a key leader in A.L. Williams, pretty much responsible for A.L. Williams growing to the level that they grew to attract the attention that they did of the company that bought them and turned them into Primerica Financial Services. When that happened, Jody's father, Hubert, had 50 to 70% of the sales force in A.L. Williams was actually his. He was the leader of that team. When that happened, Hubert broke away, and then he and Jody started a company called World Marketing Alliance, which very quickly grew to be one of the largest financial services organizations in the world, doing as much as $65 billion in insurance in 1 year. Now, Jody is a national speaker, a national sales trainer, and a consultant to high-level companies. I could tell you who they are, but then I'd have to kill you. Just kidding. But Jody and I are working together in Worth Unlimited. He and his father are making Worth a key piece of their current organization, marketing organization for financial products as well. And that's a separate project, but if some of you are in financial services, please feel free to contact me, and I'll put you in touch with Jody so you can look at what he and his father are doing now today. Now, why did we join Worth Unlimited? Well, in a word, we joined it because of the leadership team and because of the product. This product, the Worth account, is like nothing you've ever seen before. I've had people that were in financial services for 26 years, 30 years, tell me that in all their years of financial services, they have never seen a program that works like the Worth account and that works as well as the Worth account works. The Worth account is the brainchild of Skylar Whitman and John Wishenko. They founded United First Financial along with their co-founders, and immediately the company started catching the notice of financial professionals around the country. We were featured on the covers of many magazines multiple times. These are just two of the magazines that we were on the covers of a couple of times. The founders were awarded the Ernst & Young Entrepreneur of the Year Award in 2008, which is a very difficult award to win. They were awarded that award in 2008 in financial services in their area. Now, the company got started, and its roots were in the mortgage industry because Skylar and John owned a mortgage company, but they started in 1997. And in 3 years, their company was one of the fastest growing companies in the state of Utah. and they were recognized as such. However, they noticed that their vision in the mortgage company was not coming to fruition, because their vision when they started the mortgage company was, they were young men with young families, and they wanted to help other young families like themselves buy their first home, pay off their mortgage, and build a future for themselves and their kids. And they would do things like have free seminars, and they would teach their clients how to accelerate their mortgage and get that debt taken care of, and how to get out of debt in general. Only they found that the problem was that it's really easy to teach people these financial principles. It's a lot harder to get them to stick to them. And they would find that people were coming back home over and over again looking to refinance their mortgage, pull equity out of their house to use it to pay off credit cards. And then they come back home a few years later looking to do the same thing. This was just a revolving door, putting people further and further behind their goal of being debt-free. Now, they started looking around for solutions to this, and John actually discovered a mortgage concept that makes up about a third to, sometimes I've read different statistics, over half of the mortgage industry in countries like Australia and countries in Europe. It's called an offset mortgage or a current account mortgage. You can go look that up. And it's a totally different way of doing a mortgage for a home. It's like a giant home equity line of credit. And when you treat that mortgage the proper way, it will pay off a home faster and with greater savings than a 30-year fixed amortized mortgage. Okay? Now, John recognized that this mortgage was really mathematically superior to the 30-year fixed. But he also recognized there were two problems with it. One was this mortgage wasn't even available in any large numbers here in the United States. There was only one company offering it. And then two, well, actually three problems. Two, it was a mortgage, which meant that anytime you bought a new home, you'd have to get a whole new mortgage. And then the third problem with it was discipline. Because if you didn't treat the mortgage properly, it wouldn't reap the benefits. In fact, it could actually end up performing worse than a 30-year fix if the client was not disciplined with their finances. So John went about and looked at those problems and realized that, hey, he could come up with a workaround solution that would achieve the same results as an offset mortgage, and he could do it with a software program that would motivate people to stay on track with their finances. So he could solve all three of those problems with this one solution. So they came up with what was called the Money Merge account back then. They sold it to over 400 homeowners as a test. Then about 2 years later, they started selling it to some other folks. And 4 years afterward, they went back and they looked to see how people were doing with it. And they found that 95% of the people that they had sold that program to were logging in weekly or monthly to use their program. They were sticking to it. They had not dropped it like so often people do with financial strategies or financial plans. Also, to this day, we still are getting our clients reporting to us that on average they're getting 20% better results using our program than what was initially projected for them when they first got on it. So we know that mathematically the program works, and we know psychologically the program works. Okay. Currently, we have over 70,000 clients using this program, which is now called the Worth Account, to become debt-free. And we have many clients that have already become debt-free using the program. Now, these are just some of the magazines and the awards that we have won. Editor's Choice Award from Personal Real Estate Investor magazine. Real estate investors love this program because this really takes somebody and turns them from a real estate buyer into a real estate investor. I had a client that I was able to show him how, using the same cash flow and our program, he would have 5 houses paid off free and clear in the same amount of time that he would normally have only paid off 2 or 3 of them. Now, if your goal is to buy and hold real estate, maybe become a landlord, and build your retirement through a nice residual income of rental properties, our program is perfect for you. Also, it's been endorsed by some of the top financial professionals in the country. Not just Brian Topor, who is the publisher of Broker Banker magazine for the mortgage banking and the mortgage broker industry, who personally endorsed it. Also Mark Victor Hansen, who wrote Chicken Soup for the Soul and 1 Minute Millionaire. He said he wished he'd invented this himself. He told me he was saving over $600,000 in interest on his mortgage using this program. This program is not just for people that are in financial distress. This program is for people that do well with their money, but they want to do better. They want to be even better money managers, save interest, and build greater wealth. Another endorsement we received was from a gentleman named T. Harv Eker, who wrote Secrets of the Millionaire Mind. And again, if you just look at the people that are involved with this company, you'll see how much credibility it has. Now, why does this program work the way it does? Well, it does because we all need a financial GPS. Okay? The average American has 11 to 13 lines of credit. They all have different terms, interest rate, balance, and payment amounts. Okay? There are literally thousands of ways at any given point in time somebody could be paying off these debts. So the question arises, how do you pay off your debt in such a way that you would know it is saving you the absolute most amount of interest and getting you out of debt in the quickest way? Because isn't it true that getting out of debt the slow way versus getting out of debt the fastest possible way, getting out of debt the slow way could leave tens of thousands of dollars in interest laying on the table. Money you could have saved, but you did not because you didn't get out of debt the fastest way. You just did it any old way. Well, there's 3 strategies of the Worth account that make this program work. It has banking strategies built into the algorithms of the software that uses such things as concepts of interest cancellation and float. It leverages the arbitrage between interest rates on your various debts. This is a lot of technical mumbo jumbo that if you work in the banking industry, you understand. If you don't, you're not going to really understand what it means. But the bottom line is we're using the same banking strategies that major banks have used for years to get ahead and to build their wealth. We have just built them into a software program to do it on a little smaller scale for an individual or a homeowner. One of the strategies that's used is an accelerated mortgage payoff if you have a mortgage. This program doesn't have to be used on a mortgage. We have a version for people that only have consumer debt. And that's actually our least expensive version. And it's great for people that are looking to buy a home at some point, but they haven't been able to because, maybe their debt to income ratio is too high or their credit score isn't perfect. Another concept that this program uses is strategic debt payoff. And what I mean by that is it acts like a financial GPS. It is constantly at any given point in time calculating for you exactly where your discretionary income needs to go and toward what debt in order to get you out of debt the quickest way, and the quickest way for you, meaning the quickest way out of debt without putting you in a financial bind or making you financially uncomfortable. And you'll learn a little bit more about how that works as you learn more about the program. Now, part of how this program works and part of why it works so well is the coaching and education that comes along with this program. A lot of people mistake our program for just a piece of software. It's not. It's by far not just software. You have unlimited coaching and support with this program. When you ever have any problem or question at all, our staff is there to help you for the life of this program. 2 things you get with this program is unlimited coaching and support and unlimited upgrades for life. I bought the very first version of this program. I recently got upgraded to version 5 at no cost to myself. I got all the new features of version 5, and believe me, this is like night and day compared to our first program that came out, and that program won awards. It didn't cost me a penny for these free upgrades. Now, let's talk about the principle of how this program works. And I'm going to try to get through this kind of quickly, okay? Because we cover this every Wednesday night on the company's opportunity call. So if you ever want a refresher on it or you want to see the most current version of how we're presenting it, you can go there on Wednesdays. But let's just show you real quickly a sample mortgage. And, there's a little bit of a problem with a 30-year fixed rate mortgage. And that is that in the early years of the mortgage, you're paying most of the interest. Okay, and you're paying most of the interest because the balance is higher, obviously, at the beginning. Okay, the average person, before the economy crashed, would refinance their home every 5 or 7 years, which meant that they would start that amortization schedule over again, reset the clock at 0, and start paying off all this interest, and they'd never get ahead on the principal part of their mortgage. Because logic might normally make you think that you would be halfway done paying off a mortgage when you're in year 15 of a 30-year mortgage. But you can see here very clearly that when you look at this $200,000 mortgage, you see that the balance of that mortgage doesn't get down to half of that, to $100,000 in year 21. It takes you 2/3 of the time of this mortgage just to get it halfway paid off. And by the time you're done paying off most 30-year mortgages, you will have paid double or close to double, even at a lower interest rate than this, than your home was worth. Well, in the old days when homes were appreciating a lot of people didn't worry too much about paying double for their house because they figured by the time they went to go sell their house, the appreciation would have caught up to what they put into it. But now, with homes not appreciating or even have taken a big hit and depreciated, now everybody should be a lot more concerned with how much interest they're ultimately putting into their house and they're paying for their house, because you don't want to be in a position where your home is a detriment to you and not a benefit. Okay? Now, let's look at a traditional prepayment example and how that affects this mortgage. Let's just say, for argument's sake, and I know this doesn't happen very often, but let's say we moved into our home and we had set aside a bunch of cash for our closing costs and for moving expenses and stuff like that. And when we got done, we realized we had an extra $5,000 left over that we had not used. And so we're like, well, let's just take this $5,000 and send it in with our first mortgage payment and reduce the principal balance of our mortgage. Let's see what that does for us. So we send that in, and we now have a new principal loan balance of only $195,000. We still have the 6% interest rate. We didn't change our interest rate. We didn't change our monthly payment amount. It's still going to be $1,199. However, now instead of 359 payments left on our mortgage, we only have 337 payments left. Okay? We also have now reduced the amount of interest we're going to have to pay on that mortgage overall. We reduce the amount of interest that we're going to have to pay by $28,304. Now, if you take the $5,000 out of that we just sent into the mortgage, just for argument's sake, we still put ourselves ahead $23,000 in interest cancellation with one prepayment of $5,000. Now, again, I know that most people don't have this kind of money to send into their mortgage. I'm only showing you this as really an example of how sending in extra money to your debts work as far as canceling out the interest that you're scheduled to pay on them. This is something that most of us never really look at. Now, the program originally was set up, as I said, to work on the concept of mimicking an offset mortgage or a current account mortgage found in Australia and Europe and England, by the way. In fact, Richard Branson's company has a version of the offset mortgage called the One Account. It actually used a line of credit sitting next to your 30-year fixed mortgage in order to mimic the results of this current account mortgage. That was John's concept with the software. And what the software would do is it would actually measure your cash flow coming in, your money going out. It would calculate, because it was constantly re-averaging your numbers, the software would know exactly how much extra money you would have in any given period of time, and it would direct you to take that money from your line of credit and send it into your mortgage. Because people are psychologically more motivated to pay down a debt, like a line of credit, than they are to build up money in, say, a savings account. Okay? And that's how the concept was originally started. And it worked very, very well. However, when the economy crashed, it became a problem because, of course, not very many people could get a home equity line of credit anymore. They either didn't have the equity in their home or their credit had taken enough of a hit through no fault of their own that they didn't qualify for a HELOC anymore. Well, fortunately, we were already in the redesign of our software, and we already were in the process of redesigning it so it would just attack debt where it sat. And so that's the version of the program we have now with version 5. So it works off any particular line of credit. You really only need a checking or savings account along with the debts that you have in order to use this program. However, the highest and best use mathematically of this program is still with a line of credit, like a home equity line of credit or a personal line of credit. What's happening, though, is that 95% of our clients are getting on this program using the accounts that they currently have in place. They don't have to refinance anything. They don't have to open any new accounts to get the system to work. None of that. They just plug in and go. If down the road, a year or 2 or 3 years down the road, they've now built enough equity into their home to get a home equity line of credit, or their credit is improved enough that they can get a personal line of credit, they can plug that into the system and they will get a little mathematical edge that'll help them save even more money. Okay? So let's show you real quickly how the program works mathematically with a line of credit. Let's just say we have a $200,000 mortgage and we have a line of credit over here. Let's just say it's $10,000. That just means that's the available credit that we have, and or that is what we've got sitting in a checking or savings account, okay, just for argument's sake. Well, let's say we start off by borrowing that $5,000 that we talked about from our line of credit and sending it to our mortgage, just like that example that I showed you a minute ago. What happens with that? Well, we know the savings that we enjoyed from it, but you might be thinking to yourself, why would I borrow $5,000 from this line of credit and send it to my mortgage? I'm just borrowing money and building up one debt to pay off another debt. That doesn't make any sense. Well, it makes perfect sense when you understand how you're going to use that line of credit. Because what's going to happen with this line of credit is you're going to borrow $5,000 from it. But when your income comes in, you're going to immediately deposit all your income into that line of credit. And when you deposit your income into that line of credit, what is going to happen to the principal balance of that line of credit? It's going to be reduced, isn't it? And if you understand how these loans work, you understand that the interest is calculated differently on an open-ended line of credit than it is on an amortized mortgage. Okay? On a line of credit, the principal reduction happens the minute you make a payment, meaning that you immediately cease paying interest on that amount of money. In a regular 30-year fixed mortgage, you can send in extra money at the beginning of the month for your mortgage, but they're not going to apply that extra money until the day that your mortgage is due. And so you don't enjoy any kind of savings of the interest when you make that extra payment if you're making it at the wrong time. It's all about the timing. Okay? I had a banking executive one time tell me that our program was, in his mind, like a sweep account for homeowners. If you know what a sweep account is, you'll understand what he was saying. Technically it is not, but the concept is very similar. Well, let's look at a model monthly budget, okay? And of course, I know this isn't your budget. We're just using this as an example. But let's just say for a second that our monthly net income is $5,000. And let's say our monthly living expenses is always $4,000, which means that we always have $1,000 in discretionary income left over. And when I say discretionary and I say living expenses, I want to make something perfectly clear. This program is not about depriving yourself. When we run your savings analysis and we ask you for your discretionary income, we want to make sure that that's your true discretionary income. Your entertainment expenses, you're going out for dinner a couple of times a week or a couple times a month, or going to the movies, or having pizza and beer on Friday night, that's part of your living expenses because you have to enjoy life in order to live. Okay? Discretionary is the money that you would normally maybe move over to your savings account because you truly didn't spend it that month. Okay? So let's just say, for the sake of argument, that this particular client generally has $1,000 in discretionary income. And, currently they're just maybe sticking that in their savings account. Well, here's the concept. In month 1, they buy our program. Now, our program pricing ranges from $750 up to $3,500. It's based as a percentage of what it's going to save the client. So if the client isn't saving as much, they're not spending as much for the program. But let's just say, for this example, that the client is saving a lot of money, so they paid the maximum price for the program of $3,500. We want to make this the worst case scenario. Okay? So they have a line of credit. They borrowed the $3,500 out of that line of credit to pay for our program. So it automatically starts off with a $3,500 balance on their line of credit. They have to pay their living expenses that month. That's $4,000. So that brings our line of credit balance up to $7,500. But then, of course, during the course of the month, they had their income come in, which equals $5,000. It lowered the average monthly balance of their line of credit to $2,500. They're going to pay interest on that of $20.83. Are you following me so far? And in month 2, a similar thing is going to happen. They have a starting balance of $25. Their income and expenses come in and out. Their average monthly balance ends up being $1,500. In month three, something's going to happen because the software is going to see, wow, okay, when we put in our income this month, it means that the balance on the line of credit is only going to be $500. Now these people can afford to go ahead and send more money to their mortgage again. Well, they obviously sent $5,000. They obviously, we know the impact of sending money to their mortgage. So the software is going to prompt them to transfer a specific amount of money. It's not going to be $5,000. In this particular case, it's $3,675.77. Okay. Now, why is it that amount of money? Well, because that's what the software calculated to be their optimal amount of money to not cost them too much interest on the line of credit side, but still saving the maximum amount of interest on the mortgage side. Okay, so it'll make that funds transfer, and again, it leaves an average monthly balance on the line of credit, and they do pay an interest on that line of credit. Well, I'm going to go ahead and I'm going to kind of jump to the end of this real quick, but I want to show you first what the impact is of that one transfer. In month 3 of this program, they have already canceled out $17,000 of interest on their mortgage. Now imagine if the debts that they were paying off weren't just the mortgage. Imagine if the debts they were paying off were credit cards at 17%, or a student loan at 10%, or a car loan at 6%. Okay, it could be for any type of debt that they could be paying off. But in this particular case, it is a mortgage. Their interest cancellation is $17,249, and they've reduced their mortgage by 18 months. Now, I want to actually point out something else. Normally on their mortgage amortization schedule, between month 1 and month 2, their principal payment, as you see, on month 1 of that mortgage was $199, and in month 2 it became $200. So the amount going to principal each month with their mortgage payment only went up $1. In month 3 it went up another $1. But look at the effect of what happened when they made that principal payment. Their principal amount jumped by $19.38 now. So that's a permanent jump, meaning that every month that they make a mortgage payment, almost $20 more is going to their principal of their mortgage instead of just $1 more. Okay? Do you understand how that has a snowball effect on paying off the mortgage? So I'm going to go ahead and I'm going to skip through some of these other months because you kind of got the gist. They're putting in their income, they're paying their expenses, the software is monitoring it, it's telling them when to make these transfers. Here's the end of month 12. Okay? Just the end of the first year. By the end of the first year on this program, they have reduced their mortgage by 53 months. Yes, they have paid an interest rate on that line of credit. They have paid a total of $297.89 in interest on that line of credit. But they have reduced the amount of interest they're going to pay on that mortgage by $50,000, almost $51,000. Now that's just at the end of the first year. Okay? Now, what happens when they get all the way through their mortgage? Now, of course, if they stop doing this at the end of the first year, is it still worth it for them to do it even if they only did it for 1 year? Absolutely. Okay? And imagine this. Even if you're only going to keep your home for 3, 4, 5, 6, 7 years, how much more valuable is it when you go sell your home when you have more equity in it? It's immensely valuable. Okay? Now, here we go at the end of year 1 with a now permanent principal contribution to that mortgage every month of $75, almost $76. And at the end of the mortgage, compared to what they were doing, here's what their results are. With the conventional mortgage of $200,000, it would have taken them 5.5 years to get their balance of that mortgage down to $184,000. As you see with the Worth account, they were able to achieve that in just 1 year. So they're 4.5 years, almost 4.5 years ahead of schedule. Their repayment time normally would be 30 years. Their repayment time is 10.4 years. Normally they would have paid $231,000 in interest. They paid well under half of that. They paid only $70,000. So they saved $161,000 in interest. They saved more than double the amount of interest that they ended up paying in interest on that mortgage. Now again, this does not have to be just for a mortgage. It could be any kind of debt. And here's what the software looks like. And I like to show you these little things of the software because there's these little things called dashlets up at the top of your screen. They're the little boxes that tell you that you only have 9.3 years to pay off, that your remaining interest that you're going to owe is only $68,792, that you're on track to save $171,000 in interest. And if you'd been using that program for a period of time, on the right, it would tell you what your actual interest savings already is. So for those people, it would tell them their actual interest savings was $50,000 already. Okay? I call these little dashlets behavior modification tools, because this program addresses the reasons why people traditionally don't stick to a financial plan. This program addresses the left brain, the mathematical side, and it addresses the right brain, the psychological side. The different features of the Worth program that are built into it, which clients will see when they actually get their demo of the program, we have text messaging interactions. It's updated live from their account, so people don't even have to update their programs already. We have a true cost feature that shows people what stuff really costs. If I was using the program when I went to go buy that barbecue grill, for instance, I could instantly go look up and see what that barbecue grill was really going to cost me in terms of my personal debt load and the amount of interest I was contractually obligated to pay on any debts I had. Now imagine that. Imagine being able to make smarter financial decisions because you know what stuff is really costing you. You know, I had a gentleman that I was selling this program to, and he was actually the owner of a mortgage company that had about 80 mortgage brokers in it. So he was a pretty big wig guy, okay, been in the industry for a really long time. And I asked him, I said, give me an idea, give me an example of your stupid spending. And he just like said, what? I go, you know what I mean. I go, give me an example of something you spend money on a regular basis that you know is really a waste of money that you really don't need to be spending money on, but you do it anyway. And he's like, he just laughed and he goes, okay. He goes, I have to admit it's the coffee. And you know, we had already talked about the latte factor, right? And about how a $4 cup of Starbucks coffee could really be costing you $6.50 or $7 or $8, depending upon your debt load. And I'm like, really? He goes, yeah. He goes, you know, my wife gave me a beautiful coffee and espresso machine for the office at Christmas. And he goes, and here it is halfway through the year. And he goes, and I still haven't even used it. He goes, I still get my coffee downstairs because it's just easier. And I go, okay, so how much do you spend on coffee every day? And he's like, well, you know, he says, I usually spend about, you know, $4 or maybe $8 if I go down and get another cup. He goes, and sometimes it might be $12 because I might get a biscuit. You know, because he was British, so he called muffins biscuits. Anyway, so we just took an average of that, and we figured out what he was spending on a monthly basis on coffee. We backed out what he would spend on coffee if he was bringing coffee into the office to make himself and his coffee machine, and we used that on an amortization schedule on his mortgage, and we found out that that coffee was costing him something like $35,000 in interest on his mortgage. It was a ridiculous number. And he's like, holy moly. And he was like shocked because he had never done this himself to actually sit down and figure out what that coffee cost him. And so, you know, he actually ended up buying our program, and he told me, he says, I'll buy your program under one condition. And I'm like, what's that? He goes, that you never show my wife what we just looked at. And I'm like, okay, I promise, okay? And so the true cost feature is really great for helping people make better financial choices, because what our program does is it actually turns the normal dynamic of sticking to a financial plan on its head. See, the reason most people normally don't stick to a financial plan is that a financial plan does not have what I call a new car smell. See, everything we do in life, we do for a feeling. And we get a lot of positive emotional feedback when we buy stuff for ourselves. We get a temporary high or a buzz off of that purchase. We don't get a high or a buzz when we don't spend money, right? Okay, that little financial plan sitting on a piece of paper at home doesn't make us feel good when we don't spend money. However, what our program does is it turns that dynamic upside down. Those behavior modification tools in the software reward you emotionally for doing the right thing, and they punish you emotionally for doing the wrong thing. Okay? So this program doesn't make you feel like you're depriving yourself, because every time you make a smarter financial choice for yourself, you're rewarded by seeing your financial goals improve right before your eyes. Okay? It's like a big financial carrot dangling on the end of a stick. Now, again, it's not about not spending your money. It's about spending your money in smarter ways. So the true cost feature can show you still make the decision to spend your money however you want. Again, it's simple to update. It's a tracking tool. It functions as an account register, and it helps people track their monthly budgets. Now, here's some little examples of how the strategic payoff work for the program. I'm not going to get into a lot of that, because basically whether it's working off a checking or savings account, as a lot of people use it when they first get on it, or whether it's working with a line of credit, like a personal line of credit, a credit card, or a line of credit, the concepts are still pretty similar. And the bottom line way to think about it is just as a financial GPS system. Okay, just like your GPS system in your car, if you were to get off track when you were going somewhere, it's going to recalculate and get you back on track. So does this program do that for your finances. And again, the reason this program works is because it is easy for people to stick to. After 4 years of use, 95% of our clients were on track, and we get all kinds of testimonials. If you go to our worthunlimited.com website, you will see over 1,000 testimonials there from clients. Now, some of those testimonials are there just saying how great their coach was, or their customer service person. Some of them are saying how great the program is. But we get a lot of quotes like this lady, who was one of those people, and I have to admit, I used to be like this a lot. I used to go shop sometimes just for entertainment, okay, until I got on this program, and I realized that shopping for entertainment was hurting my ability to retire, okay? And now I'm excited when I don't spend money, because I know that money is going to be going into my retirement. It's going to help me to travel more. It's going to help me do the things that I really am looking forward to doing. Our average client is saving over $900 in interest for every month they're using the program. Now, how do I get to that number? Well, our average client is saving over $120,000 in interest. And our average client is paying off all of their debt, including their 30-year mortgage, in 7 to 11 years. So take the worst case scenario there, the 11 years, and divide the $120,000 by the 11 years, and you come up with $930 in interest savings for every month they're using the program. But after you've already seen those math examples, you also understand that the majority of those interest savings are at the very beginning of usage of this program. Now, that's something that's very important to keep in mind, because one of the hardest things there is to do about introducing this program to people is getting them to stop procrastinating. Procrastination is the death of success. And it's one of the main reasons so many people are in debt, because they simply procrastinate on taking action to change their ways. Now, I actually developed a little breakthrough procrastination tool with clients that were procrastinating on getting on the program. And I would just say to them this. I go, look, you've seen the math. You've seen how much money this program is going to save you, or maybe they haven't yet. Maybe they haven't even run their savings analysis. But I'd say something like this. I'd say, look, you've seen what our program is saving our average client. That works out to be over $900 in interest savings for every month of program use. You've already procrastinated a month on learning how this program is going to work for you. Imagine if you're our average client. How many more months do you want to let $900 slip through your finger? Okay? And that's really an important way to look at this. Because whether somebody thinks that they're going to be able to get on the program right away or not, because even though we do finance the program, a lot of people like to be able to pay for it up front. But some people are in such a tight money position that, they're kind of hesitating because they're not sure they're going to have the money to invest in the program right now. But it doesn't matter. They should at least get their savings analysis run. Because once they get that savings analysis run, they can see what the monthly savings is for them on average. And that will actually help them make that decision again on how long they want to wait before they start enjoying those kind of savings. Now, what would it mean if your clients had more financial discipline? Again, of all the people that go to a financial planner, only 14% have stuck to that financial plan by the end of the first year. By year 2, it drops to 11%. Our program, after 4 years of usage, 95% of our clients had stuck to it. More than half of our clients were getting better results, and on average, our average client is getting 20% better results. The thing is, there needs to be a roadmap, a light at the end of the tunnel for motivation. That's what our program provides. It's like a financial GPS system. And the best way to get people interested in this program is just ask them, if there was a way that you could get out of debt in less than half the normal time, a way that would save you tens of thousands of dollars in interest, maybe over $100,000, and you didn't have to refinance anything, you didn't have to significantly change your lifestyle or change your overall budget either, would you want to learn more about that? Would you be willing to invest 20 minutes of your time to learn about something that could change your financial life forever? And again, we get quotes from clients all the time. Please go look them up yourself, and you'll see the clients tell us that, you know, their lifestyle has actually improved. It hasn't gone down. They're paying off debt, and they're doing things that they weren't ordinarily doing. Because you know what happens when people stop spending their money on stupid stuff? That means that they have more money to direct toward things that are really meaningful for their life. For instance, that guy might have stopped drinking his coffee every day and making his own coffee, but that's going to give him more money to maybe take a nicer vacation every year. Something that really improves the quality of his life. Okay? These are all choices people make for themselves. Our program is the perfect blend of technology and psychology. Comparative calculations, it's like it was designed by a Harvard math geek. And Dr. Phil. The psychological tools address the right brain and motivate people to stick to the program. Again, people get better results than what they expect. We hear this over and over and over again. So, now, what can you do with the Worth account? First, if you're looking at the Worth account for yourself, get a savings analysis so you can determine what your investment in the program is going to be compared to what your projected savings are going to be. That's how you make an informed decision. And I'm sure we'd all agree that we'd all spend $3 all day long if we knew it was guaranteed to save us $100. Well, our program comes with a guarantee. And if you're smart, of course, you're going to make sure that your program never costs you anything to use because you're going to be referring other people. And by the time you've referred 3 or 4 people, you've now earned more in referral fees than you ever invested to use the program for yourself. An analysis looks like this. You'll be getting one of your own soon, and you can download one from the back office. As you see, this particular analysis indicates that these people are going to be paying off their 30-year mortgage in under 10 years. They're going to save $169,000 in interest, but what's this? What's this $732,000 sitting here? Well, that is projected cash accumulation, okay? See, our average client over a 30-year period is going to end up over $500,000 better off using our program than what they were doing before they got on the program. Because not only do they have what I call the upfront savings, the hard savings of the interest that they didn't have to pay, but imagine if you have 20 years of mortgage payments you didn't have to make anymore. And imagine what happens with those mortgage payments if you're just sticking them in the bank at 1% interest. And of course, I'm sure you can find a lot of better places to invest those mortgage payments than in a savings account at 1%. But in this particular example, if they had done that, even just sticking them in the lowest interest rate account they could find, at the end of 30 years, when normally they would have been just paying off their mortgage, they would have almost $750,000 sitting in whatever investment or retirement account that they have, or maybe sitting in rental properties, or whatever they're doing with their money. Okay. Again, people love the program. These people got on it. When they first got on it, it projected they were going to pay off in 6.1 years. Instead, they're going to pay off in 4.7, according to what it's currently showing them. We have now, the latest numbers was that we have currently allowed people to pay off over $400 million in principal reduction so far. I am sorry, I'm having a problem with these little slides. They're jumping forward too ahead. Okay, so how do you make money with the Worth account? Well, very simple. Tell somebody the good news. Ask them. If there was a program that could save you over 50% of the interest you're paying on your mortgage and debt, would it be worth 20 minutes of your time to learn about it? Okay? Do I have to refinance anything? No. Do I have to change my budget? No. Your overall budget remains the same. We simply redirect some of that money within your budget. Free to get a savings analysis. Help people get set up for a free savings analysis appointment. Now you're done. Okay? The company will do the savings analysis. They do the presentation. They move people forward, getting them into the program. Currently, of the people that we are putting into appointments that are qualified, meaning that they can afford to get on the program, and it is showing significant savings for them. Because remember, we will not sell this program to just anybody. It has to really be working for them. But we are actually getting over 80% of those appointments moving forward and getting on the program. Okay, you earn up to $1,000 per referral for each client that gets on the program. It could be a little less, it could be a little more. We have a sliding scale from 15 to 30% commission. The volume goes up. There's some bonuses built in there. The average commission is usually between $300 and $900, but once you start hitting those high volume marks, it even bumps up even more. Okay. Again, it's a great prospecting tool for your core business. It's a great value-added service. Are you in a business where relationship building is a key to referrals? Worth is your foot in the door, your Trojan horse with those people. If you're in a business where you're not allowed to give people referral fees for referring clients to you, like financial planning or real estate, guess what? You can get people involved with Worth, and they'll make referral fees referring people to Worth, and guess who's going to be involved in that? You are. Okay, so imagine that client's referrals to Worth and how they could bleed over into your other businesses. Okay, another way that this is a great Trojan horse for any of you where it would be valuable to be a go-to person for a large company. Imagine if you were a benefits provider or a financial planner, and imagine if you could get your foot in the door with a company that has 500 to 1,000 employees. The Worth account makes an excellent voluntary employee benefit for a large company. And you can learn more about that at another time. But imagine being that go-to person for all those companies' employees for this program and how it could develop other business for you. Again, customers love our program. There's over 1,000 testimonials on our website. How do you get started? First, you have an incredible product. You have a target market of about 85% of the population out there. There really is no sales process because the company's doing the sale for you. All you're doing is learning, referring, and earning. There's management expansion opportunities for you to make overrides off other people you bring into the company. Again, no selling. Here's your income. Now, there's other ways for you to play around with the income. You can download the commission structure off the back side of the agent website. There also is some little videos on the opportunity website that you have. Mine is worthpartner.com or worthagent.com. Little video there. But here's some little examples, okay? And by the way, I can also email you a copy of the Goal Setter. The Goal Setter is an Excel spreadsheet that I took screenshots of for this in order for you to project what your income is going to be based on what your sales are. But let's say that you referred enough people in a month that you had 3 sales happen. Now, chances are that would mean that you probably refer about 6 people over the course of the month, okay? Maybe only 4, okay? But you referred enough, 3 of them bought the program, you're going to make about $1,800 that month in income. That's going to be around $20,000 a year if you're only, say, doing 3 sales a month. What if you could do more? What if you could do 8 sales a month? That's not that hard, okay? that might only be a couple of 3 referrals a week, translating into 8 sales a month. Now you're up at over $7,000 a month in income and annual revenue of almost $90,000. This is just on your own efforts. This is not anything else. Now imagine if you could just dial for dollars and you're calling people in professions that could be good referral sources for your core business, and you're just asking them something simple like, hey, if I could show you a value-added service that you could add to your business to create an additional income stream for your business, something where you could earn thousands more dollars a month just doing what you're already doing, would you be interested in looking at something like that? Well, guess what? They say yes, they're interested in looking at it. As part of their due diligence, a lot of those people are going to be buying the program from you as well. I call that the recruit to sell approach. I allow people to sell the program to themselves as part of their own due diligence, okay? Now, let's say that you start bringing people into your team. And let's say your monthly sales drop from 8 to 4. So you're only really having about 1 sale happen per week, okay? But you brought in 3 agents yourself, and frankly, they're lazier than you. They're only doing 2 sales a month. But they did bring in some other agents themselves who brought in some other agents. And so now you've got 3 agents on your first line, you've got 6 on your second, you've got 12 on your third. And they're all doing 2 sales a month. Well, you know that's never going to happen. Some of them are never going to do anything. But then you'll have that one person out there that's doing, 30 sales a month, okay? So, because, even a blind chipmunk finds a nut once in a while. And you'll find those heavy hitters. You'll find those people that excel at everything they do, that go out there and attack this and really make it a really focus of their business. But let's just say you had this amount of a team built, and they were all producing about 2 sales a month. Well, your override commission now from them is about $5,000. And you add to it your own monthly commission. Now you're making about $8,000 a month in income. You're making over $100,000 a year. You're making a 6-figure income, and you're doing it off something that's really only a part-time thing, okay? This is just something that's become a value-added service for your business. You're really not spending much time on it at all. Now, it does take you a little while to get to that level. It took me over 9 months to get to that level with the company before. But once I made it to that level, my income would range. It would go up or down because it's all sales-based, but my overrides would range from between about $4,000 and $19,000 a month, okay? Well, I was pretty happy with that, even though it did take me, a good chunk of my time. Even though I was working part-time, it did take me 9 months of consistent part-time effort to get there. But, once you get there, it feels really good. Now, the company provides you with 2 free websites. One's focused on the program only that you can send clients to. One's focused on the referral opportunity. And both sites are sites that you can view on a mobile phone. Okay? We provide you flyers, emails, articles, banners for your website. Whatever you need, just get in contact with me. I'll help you get that set up. Oops. Oh, sorry about that. My little screens are all being funky again. Okay, there we go. Okay, sorry. Sometimes this thing is like really touchy and it just jumps me ahead 2-3 screens. Okay, here's how you get started referring. First, if you want to call me and chat, just give me a ring. Here's my phone number, 407-443-0348 for those of you that are listening. Sign up to be a Worth Referral partner at my website. It's worthpartner.com. Now, if you heard about this through someone else, do not sign up with me. Go back to that person and sign up. If you need help finding that person, call me. I will help you find them and find the correct website to sign up on. So you can go to Worth Partner and check it out, but sign up on the right website. There's no easier way to create hard feelings with people you know than to not sign up with them when they were the ones that were nice enough to introduce you to the program. Look through the training websites and learn about our programs for churches and nonprofits. We have a great stewardship program that allows churches and nonprofits to use this as a fundraiser. And that's a great way to build your team if you work with those types of organizations. If you want to work with Worth as an employee benefit, that's another great way. You'll learn about all of this on the info and training blog at teamsue.com. That's teamsue.com. And remember, I'm here to help you no matter what. It doesn't matter whether you sign up with somebody else in my team or you're signed up with me. I even often help people that are in teams that are not even our teams, because we all work together in this company, and it all behooves us to work together, because the way the compensation for this program is set up, a lot of the bonuses are based on company-wide sales. So when you help somebody, even if it's somebody that's not in your team, down the road, that's going to come back in your pocketbook in the terms of bonus, in terms of bonus money. Okay. Now, the other thing you want to do is you want to find out if Worth is right for you. If you want my help in setting up an appointment, call me. If you want to call the company directly, call the company directly. The 800 number is on my teamsue.com website. So you can always go to that teamsue.com website. I would recommend that you bookmark it so it's easy to find, or even make it your home screen so that every day when you log in to your computer and open up a browser, it opens up immediately that site. That'll remind you to keep Worth at the forefront of your brain. We also have another site, worthgps.com, that also has some other training materials on it. I'm going to leave you with this screen, and I want to leave you with this thought. If you don't ever take a step forward, you'll never get to your destination. It doesn't matter how many steps you take or how quickly you take those steps, just take one at a time. Today is the day you want to take that first step. So do that. Call us, sign up today.